everybody. Welcome this evening to StrataVenture's Monday Night Industry Webinar. We do this every Monday from 6:30 p.m. to 7:30 p.m. Central. StrataVentures is a team built by investors for investors, and we always work with quality vendors in our business, which can help enhance our real estate investing capabilities. Today, we're working with Andrew Bang of Boomerang Capital Partners. And Andrew, we're working with you. You're actually funding some of our duplexes that are being built.
Yeah.
Can't say anything but awesome how it's been to work with you.
So far, so good.
Yeah, so far, so good. Yeah, that's actually a very important thing. And don't forget, guys, that every Monday we will have key speakers that are coming in to chat with you. So at 6:30 right now, we're going to be doing our guest intro, and we had earlier a Q&A session. That's good for people to ask questions of the speaker. And then we'll go ahead and go into Andrew in your presentation. So for everybody that's joining us, if you've never used Zoom, there's some buttons that we'd like for you to kind of be aware of. You know, obviously there's a mute, there's a video. We want you to ask questions in the Q&A section, which you'll see there. And if you needed to chat with the moderator more on a private matter, feel free to go and chat with the moderator. We have Oriana and Enid right now walking you through any steps that you may need. And then also if this gets too boring and you hate making money and working with good people, just go ahead and hit the end button. And we do encourage that you guys ask a lot of questions. This is the reason why we have very, very good vendors that work for the SVI family and a lot of the participants. It's because we want to work with quality companies. So also remember, if you guys visit us at investorrealestatetraining.com, we're actually giving you guys a free one-on-one training session, which is a way for us to show what SVI is all about. It's a way for us to show you that we're all about giving, and most of all, knowing that we want to work with good quality people in our business. So with that, sir, let's get to know Mr. Andrew Bang. There's a couple of key points here. And hopefully we covered them all. If you want to give us just a little insight of everybody to get to know you, the ball's in your court. So go ahead and slam dunk it, man.
Yeah, that looks great. You guys really put that there. Yeah, so originally from Phoenix, studied accounting at ASU. I was an accountant for about 6 years before getting involved into in real estate. 2006 is actually where I got my start in rentals. There in Texas, in Austin, Texas. So I had flipped a piece of land in Arizona, and I used those proceeds to buy 3 rentals in Austin. And then 2008 is when I started flipping homes full time. And I started off at the trustee auctions. Now in Phoenix, we have trustee auctions every day. Unlike Texas, it's just the first Tuesday of the month. In Phoenix, it's every day. That's where I got my start. Then once I started buying homes there and flipping homes, it kind of just all these other opportunities pop up with wholesaling and private money and, you know, direct to owner and all those other strategies that we talk a lot about. Let me share my PowerPoint.
Okay. Give me one quick second.
Yeah. But I love this format because I can sit in my office. I'm comfortable. I got a drink. Hopefully everyone else has a drink. And, you know, you got me for 40 minutes here. So I'm going to try to pack as many tips and investment strategies and calculations as I can in the next 40 minutes.
All right. Excellent. And if it goes over a bit, you know, we love to be involved. And just before we move over to the presentation, okay. Andrew, one thing that I have here, it says, Andrew believes flipping homes can be done ethically and without cutting corners. Yeah. That is so true. You know, and I feel that's something, if you touch base with your company and a lot of the direction that your company's about, it'll definitely, you know, it helps people understand that this business, even though it's strayed kind of the wrong way here for a long time, you know, there's key people that we're all wanting to put that back in line.
Absolutely. I mean, when you're buying homes directly from the owner and you're walking into their house and making them an offer, there's a right way and a wrong way to do it. And I hope that we're all understanding that. All right. Do you see my presentation up there? Is that?
All right. You're good to go.
I'm good to go. All right. Great. Let me just move this box out of the way here. All right. So this is actually the first time that I am doing a hard money presentation. I've presented a lot, but it's normally about flips and rentals and that kind of stuff, because that's where, that's where I got started. I started doing private money in 2010, and then 2 years ago I partnered up with Boomerang, and I've been with them since January 2019, and so when I was doing this presentation, I asked one of the partners here for their PowerPoint slides, and he gave me a bunch of slides when he does presentations, and I thought they were kind of boring. And and I've been told that some of my presentations, if I don't have energy and I'm not smiling, that they can get kind of boring. So I'm not going that route. I'm just going to do a bunch of information, things that I've learned over the years about hard money, and really combining private money, hard money, and conventional financing all into one. And what are the benefits and what value you can do by understanding all three of those parts. So by the time of this presentation is done, if I haven't overwhelmed you with new information and some questions, then I haven't done what I've set out to do. So I'll also, I've got my pin here. We all see that. So I'm going to be marking up my PowerPoint slides and getting them kind of messy and with all these calculations. So this is a little roadmap that I've figured out along the way. We hear a lot of these things like path to financial freedom. And when I thought about what's been my path to financial freedom, I think about some of these gurus like Robert Kiyosaki and Grant Cardone, and talking about how you need to change your mindset about building wealth, and how it's not about how much you earn, kind of how here being an employee, but it's how much cash flow can you generate. It's the passive income investments. And what I've learned is there's a path there, and that it involves that first one. There is a lot of value to having a full-time job, or if you have a partner in real estate, that one of you having a full-time job, because if you're using all three of the private money, hard money, and conventional lending to fund your deals, depending on what you're doing with, if you're holding on to it long-term, you're going to want to get that long-term financing. And walking into a bank and filling out an application saying, yeah, I've been with the same company for 10 years. Let's say I'm a product manager for Coca-Cola for 10 years and my salary is $62,000. I can show you my pay stubs, my taxes are neat. Banks love that. They're going to approve you for that loan. You're going to get a low interest loan. There's going to be low underwriting. But if you walk into a bank and you say, I flipped 20 homes last year and I made $200,000, they're going to say, well, we don't like that as much. So there is value of having those pay steps and those salaries, and then doing the real estate in addition to that. Now, with the flips, you have all of these here, they take time and there's risk involved. And the way you want to get to this end goal of passive income is perseverance. It's learning from your failures, continuing to keep at it. I tell people who are flipping homes, you buy 10 homes to flip, you're going to make, 10 to 15,000 probably on 7 or 8 of them. You're going to lose money on one of them, and you're going to hit a home run on one of them. And you just hope that one that you hit a home run on is a lot more than the one that you lose on. And if the first home you flip is that one that you lose on, then you'll probably never flip a home again. So there is risk there. And once you get to this point where you're understanding all these different ways to earn your income, it's not about how much money can I generate, but it's how can I keep the most of the money that I do make? How can I pay, for example, the least amount of taxes? And I mentioned Robert Kiyosaki earlier. He has this diagram, which I really like. It's called the Employee Sole Proprietorship Business Investment, the ESBI diagram. And I'm going to adjust my screen so I can mark on this. The employees, the W-2, you have the salary, you have the pay stubs, which the banks love, and that's taxed at about 40%. The sole proprietorship is the 1099. It's the contractor, it's the dentist, self-employed. And that's taxed at the largest amount, that's at 60%. And your businesses, your S Corps, your flow through, your C Corps. And that's at, about 20%. And this is where, of course, we all want to get to. These investments are the real estate. It's investing in REITs, in stocks. And that's at the 15% capital gains tax. This is the goal here. This is where we want to get to. And so we want to use that quadrant of private money, hard money, conventional lending to get to that area. So here's my little triangle of the three. Boxes around. So just quickly talking about the underwriting, conventional loans, it's all about credit, right? Credit. They're going to talk about your debt to asset ratio. Now, hard money loans, it's all about the property, right? The as-is value, your ARV. And then your private money loans is relationship based. It's the rich uncle. It's the neighbor that's a dentist, whatever it is, that's the person. And what I also do, in private money loans, I also put my own money in there. I consider my own money private money. Right, and so the banks, that one's easy. It's the banks, it's the credit unions. And this is where a lot of people don't understand who are hard money loans, who are giving out the hard money loans. I'm gonna make a little room here, because there's a list of them. And if I have any questions pop up, Diego, if you just want to interrupt me, because I don't have the chat open while I'm
no worries, that's what we're here for.
All right, so we got some banks are now doing hard money loans. We have funds, we have REITs, and then within those, you have the direct lenders and then you have the brokers, right? So like a fund and a REIT that would keep the loan throughout the whole time would be a direct lender, where the broker is going out and you send a deal to a broker and he's trying to find the best interest rate by going to all the above. Now, when you look at different REITs and funds that are lending on hard money, they go about it different ways. There's no hard money lender that's exactly in this corner. There's some that stray a little here towards conventional loans, and there's some that stray towards private money. Like if you have a a hard money loan, a lender that asks to pull your credit, that wants an appraisal, they're more tied towards a conventional loan. And what's interesting is, before I got into this field, I was like, pulling credit on a flip doesn't make any sense. At Boomerang, we don't pull credit because we don't see that having any impact on whether the home defaults or not. I'm saying, so why are these other hard money lenders pulling credit, getting appraisals, charging all these points? Well, one of the reasons is a lot of these funds, they're selling their hard money loans. So if you have a hard money lender that says, I need to pull your credit, I need to do an appraisal, and I'm charging 2 points, they're actually selling their loans to some of these hedge funds. And so they're getting the credit and the appraisal to fit inside the hedge fund's lending box. They're getting the loan through you, and then immediately they're sending it over. So you're not going to have the same lender, the same person that you talk to that approved your loan isn't going to be servicing the loan, isn't going to be giving you the rehab draws, isn't going to be giving you the payoff. Where there's some lenders that go, all right, I'm going to keep it the whole time. I'm going to service it. I'm going to be here if you have any problems. And it's really closer to private money, where it's more based on the relationship than on the credit score or the appraisal. Now, why would I get an appraisal on a property? Why would I pay someone who's not involved in a deal $500 to $700 to give me a valuation on a property that they're not involved with? And if that evaluation is good or bad, either way they're getting paid and doesn't have any repercussions. That's why I've never ordered an appraisal on any house I've lended. I'm going to comp the house, and I'm going to say, this is the value that I'd sell it at. And I'm going to talk to my borrower and say, what value do you see in the house? And hopefully we're agreeing upon the same one. And if, and then I lend on the property. If the property has value in it, then I'll lend on it. So another one, so there's a big national company that's just gotten involved in hard money loans, and I see this all the time. I get their emails, 7.99% hard money loan, right? I call this a teaser rate. We need to understand the full costs that go into a hard money loan. You need to understand what exactly you're paying for and the process that's involved. So for example, it's just a numbers game when it comes to hard money loan. If you're flipping a house in 6 months or under, it's the points, it's the doc fees, the appraisals, the rehab inspection fees, all these extras that pay such a bigger deal that when it comes to total cost than the actual interest rate. And so if I have a, let's say 8% loan that charges 3 points, a 10% loan that charges 2, a 12% loan that charges 1, and a 14% loan that charges 0. Did you know all of those are exactly the same if you hold the property for 6 months? It's all exactly the same loan. Now where it gets you is, let's say that we hold the property 1 day less, just 1 day less than 6 months. And let's do an example here. I have a $100,000 loan with my 2 different hard money lenders. One gave me 8% and I paid me 3 points in 179 days. So let's go 0.08 times 100,000 divided by 360. You're going to get about $22.22 a day for that loan. At 12%, you get $12,000 of total interest a year. Divide that by a 360-day calendar. You get $33 and change a day. So if you hold that for 179 days, 1 day less than 6 months, 179 times 22. Let me get my calculator here, my cheat sheet.
That is awesome. You said calculator, Andrew. At SVI, we tell our members we don't use our brains, we use our calculators. Awesome.
3.8 plus so 1 point for loan origination is 1% of the loan. So 3 points on a $100,000 loan is $3,000. And your total you're paying on that loan, $6,977.38. Let's say you got the 12-in-1 loan, 179 times 33.3. There's 39, sorry. 966.07 plus only $1,000 for loan origination. .07. It's because I held that loan for 1 day less than 6 months. The 12% loan was $11 cheaper than an 8% loan. What's the average flip? 100 days?
Pretty much.
100 days.
Now, one of the biggest things we always tell our members or people that we're helping is your flip has a standard life, but the amount of your rehab is what will push it into the longer hold times, you know, going into a $50,000 rehab to a $150,000 rehab.
Absolutely.
You've got to take that into account.
Absolutely. So on 100 days, I mean, the math's pretty easy on here. So on that 8% loan, paying $5,200, and on that 12% loan, you're paying $4,300 and change. And so you're saving almost $1,000 by going with the 12% loan. And what I didn't even talk about here was these fees here. Getting rid of all that there. So on that the 7.99% loan, you got $500 in doc fees, 500 for appraisal. You got inspections that are $200 a pop. And if you get 5 of them, that's $1,000. You know, on that other loan, there's none of that. So you can see how that adds up quick. Even on a 6-month loan, you're saving $2,000. And if you flip it in 100 days, you know, we were at 4,300, right?
Mm-hmm.
So this one here, they're going to get you what's called a minimum interest due. 6 months of minimum interest due, which is another way of saying that there's a prepayment penalty. So whether you flip that home in 2 months or 6 months, you're paying $9,000 total to them. And then you've got a loan that's 4% cheaper, but you may not know it, you're paying twice as much.
So it's definitely an obvious question to ask for prepayment penalties and terms and guidelines from any lender that you're working with.
You want to get the whole picture. Absolutely. All right. So combining conventional loan and hard money loans. When I'm buying a rental, I don't want to leave any money in that property. You know, I want it 100% financed. If I were to just do a conventional loan, I couldn't do that. I had to put down at least, you know, if it's FHA, 3.5% of conventional, you're at 10 or 20%. So I've got to use a combination of hard money and then refinance that with a conventional loan. So with my hard money on my purchase price and rehab, I got my closing costs, I got my payments. With the refinance, I need to be at 80% of value. That's what they're going to refinance me at. Sometimes it's 75%, depending on your bank. But right now, we can still get 80%. And if we do a rate and term and not a cash out refinance, that's the way to get the best interest rate, the lowest interest rate, and also there's less underwriting with a rate and term compared to a cash out refinance. And with a lot of banks, for example, there's a credit union there in Austin called A+ Credit Union. They don't have any seasoning. So if you were to go with Quicken Loans, they'd want you to be on title for 6 months before you refinance the house. But with some banks, there's no seasoning. So you could refinance that house literally the day after you buy it with hard money. And you just have to make sure that rehab's done before they get that appraiser out there. So you take your purchase price, your rehab, your closing costs, your interest payments, and that's going to be your all-in amount. And if you can get that number to be at 80% or less than value, then you'll be 100% financed. You don't ever have to put any money into that house. So we're going to put some numbers to it. The closing costs on both sides, let's say are 3%. If you make 6 payments at 12% interest, that's really 6% of the loan. So you're at 9% total. So you take the purchase price and rehab, times it by 1.09, divide that number by 80%, and you're going to get the value you need to be at, that you need to appraise at, to be 100% financed. So doing an example here.
So Andrew, on the refinance portion from the hard money to the long term, to stay at the 80%, obviously an appraisal will be required at that point to justify the improvements and what the appraiser consideration is going to be.
Absolutely. Yeah. Once you're getting it refinanced, you're going to go through a full underwrite.
Okay.
And so, yeah, but what you're trying to do is you're trying to get a 30-year fully amortized loan at the lowest possible interest rate. You know, I've seen investor loans on rentals at 3.6%, you know, right now, which is
absolutely,
it's amazing, you know. So let me throw some numbers in here. All right. So if we got like a purchase price of 80,000 and the rehab's 20,000, 100,000, so that's an easy one, 109. Divide that by 80%, 136, 250. So if I'm buying a house at $80,000, which needs $20,000 worth of work to get it to rent ready or fully renovated, I need it to appraise for 136, 250 to at least appraise for, you know, the ARV appraised. And it's a lot easier to get a house appraised for than to sell it for that amount. That's what I found out. Then I'll be 100% financed. I won't have any money left in that property. You know, and just to throw another one on here, 190, 207, 100. So I've got to get it appraised for 158,875. It's a percentage game. Now this one, if you can buy a house for 160, put 30 into it and have it appraised for 258, you'll be 100% financed and be a great rental. The problem with this one is that'd be a perfect flip too. I mean, the flip numbers are really look really well. So you'd be competing against someone who's going to flip the house for that one, where this one, it works more for a rental. Either one would work if you could get that value there. So on a house for 136,250, what would I need to charge for rent to be able to cash flow on that property? So 136,250. I'm going to times it by my variable 00867. I'm going to get a rent of.
And for everybody that's watching us this evening, thank you so much for joining us. This is being recorded, and feel free to send your information over to the moderators, because we'd be happy to get that information over to you guys.
All right, so this is my magic variable, which I'm going to break down for you guys in just a sec. But if I take the mortgage, 136,250, times it by 0.00867, 118129 is my break-even rental number. I know if I can get at least that much for the rent, then I'll break even. And how I got that is you take 136, you take your mortgage, and you times it by your rate factor. Right now I'm using a rate factor of 6, and that gives you your yearly principal and interest payment. I saw Grant Cardone using 0.065 the other day, which I don't know why, because interest rates keep going down.
Yeah,
I like
well,
0.06.
I'll stay quiet.
And then to cover my fixed expenses, I'm going to multiply that amount by 30%. 250, which gives me a total. I'm plussing that to this number here. 627.50. And this is my adjusted expense. So my rent, 0.29 times 12, 14,175.48. So this here, that 30%, that covered my fixed expenses. To cover my variable expenses like vacancies, maintenance, repairs, I'm going to take 25% away from this side. It's going to give me 35, 43.87. Minus that from my original number gives me 10,631.63. So I have my adjusted rent, I have my adjusted expenses. I'm going to minus my adjusted rent by my adjusted expenses, and I get a total of $4.11. That's my yearly cash flow on this property. So that's break even. That would be a break even on that number. So that 0.00867, you times that number by any mortgage, and it'll give you the break even rental. And it also can give you cash flow. So if I'm charging, let's say I'm charging, let's see here. You know, 1,300 for this house. And I know that my break even cash flow is 115. I'm making 1 month times 12. I'm gonna be cash flowing $1,424 a year on that property. So if you jump on, say, Bigger Pockets or these other, websites there, they talk about how do you calculate cash flow? How do you know if it's a good deal, a bad deal? And they talk about this rule called the 1% rule. And it's basically if you buy a property for whatever you buy a property for, 1% of the sales price should equal your rent. So for example, if you buy a property for $100,000,
Andrew, sorry to interrupt, sir. I had a question that says, how did you get the magic number of 00867?
Yeah, so it's breaking down the expenses of the rental. Rentals have two sides of expenses. They have fixed expenses like your taxes, your insurance, certain things that whether someone's in the property or not, you're always going to have to be paying. And I equate those expenses to 30% of the mortgage. And then you have your variable expenses. You have your repairs. Some repairs break down into 3 parts. There's your capital expenditures, which are your big items, your roof, your AC, your big ticket items. You have your ongoing maintenance, and then you have your move in and move out. So whenever someone moves out, there's always something you got to do. There's also vacancies, there's evictions, there's damages, there's theft. This list of expenses, when you actually add up all the expenses that goes into a rental, it's really long, but it has a pattern. There's fixed and there's variable. So I need 2 numbers that I can account for the fixed expenses. I can account for the variable expenses. So I use the mortgage, that's fixed. Whether there's someone in the property renting it or not, I'm always going to have to pay that mortgage. 30% of that, I add 30% of that mortgage to it to account for the fixed expenses. Now, rent is variable. I only get rent if someone's renting the property. So I take 25% of the rent away from my annual rental, and then that'll account for all those variable expenses. And by using those 2 amounts, it's going to give me my adjusted expenses, my adjustable rent. And what I found out by doing it is that I'm using the mortgage to calculate that first one, and that 00867, like that example I gave you, I happen to give you an example that I knew would give me a 0, close to a 0 as I can for the cash flow. And so when you took, I think it was 136,250, and you divide it by 1181 and change, that's the variable you got. And so by doing that, I knew that whatever your mortgage is, that's, we talk about changing your mind frame about how you purchase properties. And this 1% rule that we learned at all these different places, it's not teaching you what to correctly look at when you look at a mortgage. You're not going to look at the purchase price and try to determine your rent. You want to look at your mortgage. You want to say, all right, first of all, if I buy this property, can I buy it and not keep any money into it? I don't want to generate, there's a calculation called cash on cash return. I hate that calculation. If I'm calculating that calculation, then I'm out, because that means I have money left in the deal that I have to say, oh, I'm making a 20% return on my $20,000 that's left in my house. I don't want to leave any money in the house. I want to be 100% financed. So if I'm 100% financed, then I have one number, a mortgage. And by taking that one number, I can times it by 0.0867, and I know exactly what I need to charge for rent to at least to break even. And so when I'm looking at all these houses that I get from wholesalers, you guys all get them 10s and 20s that come through, strata venture deals that come through my email. I'm saying, all right, what's going to be my all-in mortgage on this property? And I do that by doing the purchase price, rehab, closing cost, interest rate. So it's that 1.09 times my purchase price and rehab. Divide that number by 80%, and then I have my all-in mortgage number, right? And then I times that number by 0.0867. And so by breaking down all those, expenses, I come up with 2 numbers that I plug in, and I can look at a property and know within 30 seconds whether it would work as a rental, whether I would cash flow on it, and whether I'd have any money left into it. It's changing your mindset about how to look at rentals. You're not looking at the purchase price, you're looking at the all-in mortgage. And that's what we all need to get to.
So it saves time. It saves also, I believe that there's that little bitty niche that I think this can work, right? And then when you start looking down that path, you'll find yourself going down 1 yard, 30 yards, 100 yards, and then you're going, I don't think I should have gone down this path. Because time is basically money and everything in this business. So these are great tips and pointers that you've got here, Andrew.
All right. So let's combine all three of what we've been talking about here. So for a normal hard money loan, so what we're going to do is we're going to combine private money with hard money, and then your rentals, are conventional loans. That's where the conventional loans come. I'm going to erase that because I'm going to use that area. So a regular hard money loan, you normally have to put 15% down or so. And so you have some money in there at the beginning, or what you could do is you use private money, right, to fund that 15%. And this is what I used to do. You go out, you collect your private money, use that money. And when I say private money, I'm including my own funds. So you have your family's money, your neighbor's money, whoever you can get to trust you with their money, your own funds, and you're filling that gap. And then you're doing your flips, your rental, your JVs, and your rentals. Now, what you don't realize is you're losing the benefit of that money. If I were to buy 3 flips and each one were to be about $200,000, $300,000, I've got 3 down payments of 15%. And I've got about $100,000 in down payments. And all that $100,000 is doing is giving me the opportunity to get hard money loans on my properties. It's not providing me any return whatsoever. So with a hard money lender that understands how collateral works, you can say, all right, how can I get 100% financing with a hard money lender? Well, they talk about collateral. And there's 2 forms that are the simplest. The first one is a free and clear property. If you own a condo, a townhouse, that you bought a while ago and it doesn't have a mortgage on it, the hard money lender can put a lien on that property, and then based on the value, can give you X amount of money to go out at 100% financing of purchase price and rentals, purchase price and rehab on other properties. Now, the second one is where it gets interesting. You have an investment and you're able to sign a collateral assignment on that investment. And what that collateral assignment says, and it gives that hard money the ability to, in the case of a default of your loan with them, they can pull money out of this investment to cover the losses. And what if we can combine that collateral assignment with what a hard money lender is already doing? So let's say a hard money lender is an actual REIT, real estate investment trust. So that $100,000, and let's say you have your own $100,000 and you have your other private money that you raised. So you have $200,000 that you are using towards down payment to cover the initial rehab, on all your properties. Let's say you invested that same $200,000 in a REIT, and this REIT was giving you a great return of 11.5%, and that's 100% passive. You're going to be receiving that quarterly or however it's set up, monthly. And then because of that investment, they're saying, hey, we're a hard money lender, we're a REIT, so we're going to give you 100% financing. And that 100% financing is purchase price, all your rehab, roll in all your closing costs, and in some cases, even the interest payment. And so you have a buying ability to buy flips, to do JVs and rentals at 100% financing. So your money's working 2 ways for you. It's generating this return in the REIT as passive. And let's say you have a flip and you want to take 3 months off because you're like, oh, I'm not sure about the market, or it's the holidays are about to start in November, December, and nothing will sell in the next couple months. That money's still generating that return for you. Yep. But when you need those loans, it's there for you whenever you need it. And so let's say you do 2 flips, you make 40 grand, 20,000 on each of those flips. Let's say you do a couple of JVs in a year, you make 10,000 each on those. And then the rentals, it's interesting. They're giving you 100% financing for purchase, rehab, closing costs, and interest payments. So what you can do now is do a rate and term refinance with your traditional lender. they're going to give you 100% of the loan that is on the property, which happens to be 100% of everything that's gone into it. You haven't put a penny into that property. So you now have a cash flowing asset that's 100% financed that you never had to put any money into. Meanwhile, that money that you would have had to put into it is making a great return inside a REIT. If you could buy a rental without ever having to put any money into it that's cash flowing, how many would you buy? How many flips would you do? You do as many as you possibly could.
Mm-hmm.
So let's say in that 1 year, you're buying 3 rentals. It takes you 6 months to refinance them. So you buy another 3. So you got 6 rentals, and each one has built-in equity because you're going to be at least 80% loan to value because it appraised and you did your due diligence beforehand. You know, you're about $120,000, which you just increased your net worth, 60, 80, 180, plus the $24,000 or so, you know, that you made. So instead of just flipping a couple homes, you've been able to use your money twice. It's doing passive, and then it's doing all the investments. And that can be whatever that number is that you invested in that REIT. You're doing it 1.2 million. You're doing it 6 times your initial investment. So you have $1.2 million of money to play with to do all these that you want.
One of the beautiful things that in the SVI curriculum is that we have analyzers that really are plug and play and show you these strategies. Watching it broken down into the method of how it's done coming from a lender's perspective is something that a lot of people that are involved in real estate should see, that your lender wants you to use them. Your lender wants you to leverage this. Your lender wants you to repeat, you know, what do they call it? Rinse and repeat, you know, let's go.
Absolutely.
Because you're growing at their capabilities too. So this is phenomenal.
Yeah. So if you like those slides, you have any questions, you know, send me an email. You know, I do these presentations to network. It's a form of networking. You know, I'm an open book. I want to see if I can add value to anybody, you know, that's listening, anybody that's out there. My main focus is on hard money lending. I'm creative with what I do. I understand the flipping side because that's where I came from. I still dabble a little bit in that. I just picked up a house, and so 2018, I said I'd never flip a home again. I'm just going to do private money. I just picked up 2 homes last week. I got one in Dallas, one in Austin, and then I've got a handful of rentals in Houston that I started up. So I'm back in it. But that said, money, you know, lending is my main focus. It's my own priority. I want to get everybody to that 100% financing because that's where you really can build your wealth and you can accumulate properties really quickly, meanwhile making passive income.
Absolutely. And one of our members just asked a question here earlier. He said, Diego, how are we able to communicate with Andrew and work with him? Well, if you are an SVI member, remember that in Podio, you do have in the members directory, in the member center, you have the network vendors, and Andrew's in there. So he's an open book. Feel free to call him. I mean, I met you. You came to the office, and we both sat there and we just ran numbers, and that's why it was your numbers, my numbers, and we're just talking numbers left and right. I'm going, this is exactly what an investor should be looking at, is the numbers. Guys, there are a lot of hard money lenders out there. There's a lot of private money lenders out there. Everybody fits a certain model for everybody. Interview who you're wanting to work with. But most of all, understand that that you want the lender to help you break it down the same way you just did right there, Andrew. And we've got, and not to say for the level of business that you have, we also have other lenders that are part of our vendor network. They meet the same capabilities. So make a friend, call, right? You know, ask questions. You know, you have an accounting background. We saw it. We totally saw the numbers there. Yeah. So guys, we want to go ahead and encourage you to ask questions in the Q&A section. Andrew has some information here. Please put your questions in the Q&A section so we can go ahead and make sure that Andrew can answer those. So Andrew, what's something up and coming or new to the Boomerang Capital business? Anything you see for forecasting for the future, Any new developments? Something that you might want to talk about?
We see everything's going really well right now. We see, tons of growth within the markets. We have our own goals in house of where we want to grow. 3 years ago, we were at zero. We had one of the partners of the fund that decided he wanted to start a different fund, and we essentially started over at zero. We just hit $68 million of assets under management.
Excellent.
And we have a goal to get to, close to 80 million at the end of the year. So we are growing. The box that we've created of what we like to lend in. Once you're inside that box of, all right, flips is our main thing, and then helping people, it's the BRRRR strategy with the rentals, buy rent, so within those two investment strategies, we have a lot of capabilities, and we're a relationship lender. You're not going to see us advertise on Google ads. We like to get out, we like to talk to people. I like to do presentations. I like to come to people's offices. With my flipping background, when I decided to make this jump of lending my own money to, I need to have someone that backs me more with more capabilities. So I need to partner up with one of these REITs or funds. Boomerang Capital was a hard money lender that I used while I was flipping. And so one of my first calls when I decided to go that way was to them. And it was an easy transition for me to say, all right, I've been flipping for 10 years now. I have a lot of fun doing it, but I see that this is more my future. This is where I enjoy it more. It's more relationship based. I'm not putting all my money into one flip or three flips. I'm diversifying. And then all this education that I'm learning, doing these presentations, it's a lot of fun. I'm having a lot of fun doing it. And yeah.
And Andrew, that it's great you say that, because one of the SVI members that come in with us and take the curriculum and become lifetime family members, that is the final end all be all goal, which is to turn the funnel the other way, is to start from your flipping, building the relationship, start, inventorying some rental assets, but then eventually you have your money growing on the rental portfolio side, but then you are now becoming a private money lender or JV component to
Right.
the new family members that are coming on board. And we've exploded. We've since we went national, we've had a lot of good presence. We're really doing good things now with a couple companies that we're bringing more ability to the member base. We're going to be, I think today we had such a great final meeting with a company called Pad Split out of Atlanta, and also with Gene Garino. And all of these are avenues that our SVI members are going to be coming to companies like you, because we need that starting point, right? Let's find the property, get that starting point, and hand it over to the lenders and let the lenders help us grow our business. So you're hopefully we can help you hit 80 this year, and next year maybe a different. Now everybody comes out of the gate shooting.
Yeah.
It's going to be a great year, sir. So I got a question here from Ramon Diaz said, what should be the buying price for using the 100% financing HML in order to get some profit?
Even if you have a property 100% finance, you want to be at 70% loan to value. So that's still where we want to be. Boomerang, we lend off of cost. We lend off of purchase price and rehab, 85%, 15% down payment. But the overall value of that loan to value, or sometimes we say 70% ARV, which is similar to loan to value, but it takes out the down payment. So when I say 70% loan to value, that's adding in your down payment. But that's where you want to be, 70% loan to value.
All right. And what are you, in your overall opinion, rates? What are we thinking rates wise? As obviously we're coming into an electoral year, where some of these markets are kind of tethered in themselves. What's your overall gut feeling? Are we looking at, I know the Fed recently said that we're going to be keeping these low rates for a pretty good amount of time. What does that look in the hard money and private money lending realm?
Yeah, I sure hope so. So what stopped? So I don't know if you guys realize this. So in March, when the coronavirus hit and everything shut down, the two main funds that buy hard money loans is Torac and Pier Street. They're big hedge funds out of New York. They completely shut down. So what happened was all your non-QM loans went away overnight. And then about half the hard money lenders couldn't lend anymore because they couldn't sell their loans. And so Boomerang, we cut back. We kept lending, but we dropped our loan to value to 60 and 65%, depending on the deal, because we didn't know what was going to happen. So it seemed like for April, we were kind of in this standstill, what was going to happen. And then in May, we got back into it. And right now, everyone's buying again. So everything looks great right now. Who knows what the election's going to bring, but I don't see any indicators that it's going to slow down at any point, but we'll see what happens in November.
Excellent. And you do, what cities and states do you lend in?
So my main focus is on Texas, and in Texas, it's, San Antonio, Austin, Dallas, and Houston, those surrounding areas. And then I like all the areas in between Austin and Dallas. So you got these great rental markets like Killeen, Copperas Cove, everything around Fort Hood is just killing it with the rentals right now. Waco, I like Waco. But then, so I don't go south too much. So Galveston's as far south as I'll go. I did one loan in Corpus Christi and I just had to take that back. So I'm not going to be doing anything out there anymore. And then I don't go west outside of San Antonio. That's as far west as I'll go. But I also, as a company, we're licensed in Arizona, Texas, Colorado, and then we just got licensed in Utah.
Oh, right. Colorado. Okay, good.
Yeah.
Excellent. Excellent. All right, everybody. We still have a little bit of time there. If you have any questions, please feel free to ask away. Andrews is going to be happy to answer those for you there. I know one of our members asked a question in regards to a slide or the presentation in itself. Is there an ability for them, either obviously we're going to have this recorded, or is there somewhat of a cheat sheet one that you can provide them that we can get over to Enid, and then Enid can put that out to people?
Yeah, I'll provide my PowerPoint slides over to them. It just won't have all the things I marked down.
And what we'll do is we'll load it into your vendor profile that we've got at SVI.
Nice.
Yeah, absolutely. So guys, if you're not asking any more questions, I guess we can go ahead and get everybody back to their families.
Okay.
But before we do that, let me go back in here. Give me a second. I hope this was great information for everybody. We try our hardest to try to continue to, let me see here. All right, let me go right here. All right, let me see if you can see that. Remember that you guys can register for one of our workshops at investorrealestatetraining.com. And then also, if you want to scan our QR code right here, this is going to be posted on all of our social media. So you guys can also see Andrew and his information, not just through the members area, but also through the social media platforms of Strata Ventures. Again, Andrew, thank you so much for your information, also your time. We do focus a lot this year is going to be massively on looking at those potentials of getting the rehab, getting it done, turning around, and putting that into your rental portfolio. So my friend, you're going to be busy this year. We're striving really hard to get all our members pushing because we feel like this year is going to be phenomenal.
That's great. Thank you so much for having me, Diego.
Absolutely. Let's see if we got one last push here for any questions before that. All right. Well, sir, thank you very much. We'll see everybody next week, 6:30 to 7:30 Central. And Enid will be happy to answer everybody's questions and also send any emails out there, sir. And I'll look forward to, I think at the beginning of the year, we were planning to head out to the Phoenix area to go take a look, because you answered my question without answering it.
Mm-hmm.
It is buying properties every single day there, not just once a month.
Yeah.
So we'll look forward to chatting there, sir.
Okay. Thank you.
Yep. Everybody have a great night. See you soon and enjoy your family.